All right, thank you, Jerry. Feel free to start when you're ready.
Okay, very good. All right. Good morning, everyone. This is Jerry Muir, and today is our second session for St. Killian's Church VITA's program. And today we will be talking about some various IRS forms and publications that you'll see in the VITA program. And we'll talk about income. In the VITA program, there's a lot of items of income that you need to attend to that are within scope, which we'll talk about. And then we'll do a quick review of the Schedule A, which is the itemized deductions on the federal return, the Schedule C, which is a profit and loss statement, if you will. And we'll talk about the sole proprietorship. We do see a number of them. We're talking about sole proprietors in the VITA program. That could be someone who's making $20,000 or $30,000 a year, either as a primary occupation or perhaps maybe some type of side hustle. And then we'll give you an introduction to the Schedule D as in Delta, talk about capital gains and losses. And then we're going to talk about the adjustments to income. You'll see that in the VITA program. And then we'll actually review a tax return exercise, which is part of the PowerPoint here. We'll introduce you again to the software, which is known as the TaxSlayer Pro tax preparation software. That's the software that we use in the VITA program. And this session will go to noon. We'll break approximately every hour. And you might remember this from last week. There's no change. This is the cast of characters, if you will, at the VITA program. If you're new or newer to the St. Killian program, St. Killian has a lot of experience as far as their volunteers and their administrators. And again, this is a list of the individuals that you'll either hear about or you may see at the site. And then today, I think we have Annette Barcelo. She's from the IRS. I think she's still on the line, but our IRS tax consultant is Christine Gallardo. So she's that representative. And then you may hear the name Teresa Jackson. She's from the United Way in Orange County. They're based in Irvine. But again, just the folks that you'll either see or hear about. And I'll let you take that in for just a moment. And our IT representative this morning, Damien, is the individual who's recording, and he's our IT expert. And then you may have heard the term site coordinator. We talked about that last week. Your site coordinator is basically your operations manager at a VITA site. They're responsible for staffing the site and obviously the operation of the site. And you'll see Mel. He'll be floating around at the VITA site, most likely most Saturdays that the site's open. And Mel has Mel, if I remember correctly, I think you've done this before, have you not? A couple, 2 or 3 years ago.
Yeah, 10 for I've been doing this for like 13 years.
Okay, and I think you did last time I remember a couple 2 or 3 years ago as a site coordinator, and then of course Mel is going to be assisted by Robert Andrews, and Robert has worked at my site at Coastline College for a couple of seasons. He's pretty experienced. All right, so that's those are your contacts, if you will. Okay, and then references are important. We know that the main reference in the VITA program is going to be that IRS publication 4012, but there are many other types of IRS and for that matter, Franchise Tax Board references that you will either see or perhaps maybe dig into to find an answer. And it's okay because it doesn't matter what your field of work is. It doesn't matter if you're a carpenter, a plumber, a rocket scientist, or a medical doctor, or an attorney. There's all sorts of references that you're going to be digging into because you simply don't know the information, and that's okay. So in the VITA program, we do, I guess you would call it mini research from time to time, and then you'll hear me use the term in scope and out of scope. And what that means is if you are a VITA preparer, there are certain returns that we will not do. And those are out of scope, which means someone else is going to have to attend to them. But if something is in scope, then we'll go ahead and assist the taxpayers with that. And there is an in scope or out of scope chart, if you will, in the publication 4012. And probably the couple takeaways here is your publication 17 And that is a document that is revised every year. And it is easy to read. And the publication 17 also refers you to other IRS publications. And if you ask an IRS employee how many IRS publications there are, they will tell you many, many, many publications. There's not 4 or 5. There's literally probably thousands of them, but we only operate with just a few of them. So the Pub 17 is one of your go-to documents, along with, of course, that publication 4012. Other documents that you'll probably refer to from time to time might be the 523, where someone sells their primary residence. That's within scope of the VITA program. And if you sell your home, that could be an easy or an easier calculation depending on the information you're going to get from the taxpayer. And then, of course, your level of experience. But that's doable and in scope in the VITA program. And then a document that I've used many, many times before when I was an IRS employee. I now have tax practice and I teach taxation at a couple of colleges. The IRS publication 525, which talks about taxable and non-taxable income. And probably one of the takeaways in the VITA program, and I've seen this again and again, people will come in and say, I won some type of court award. And of course, very good. You congratulate them, and then you ask them, okay, well, what type of award is it? And typically, they'll say, well, I don't know, but I've got this document. So what we'll do is we'll take a look at that document. That could be a judgment, if you will, and we'll take a look at it to determine if there's any items in there that, again, we have to stay in scope. Any items that are taxable in scope, and you'll find that in the publication 525. And there's certain court awards that are non-taxable. But again, 525 is one of your go-to documents. Okay. And then another document that you may spend a little time in the VITA program, we do have a large quantity, if you will, of seniors, and the vast majority of them are on Social Security. And the publication 915 talks about Social Security benefits. When you hear the term railroad retirement benefits, that is for railway workers, and it's an equivalent program to Social Security. And then, of course, the 4012, you're going to have hard copies of them at the VITA site. And whether you are brand new to VITA or you are highly experienced, you will probably spend time looking in the publication 4012 for tax information, or perhaps maybe how to navigate through the software. And the 4012, when I'm at my VITA site, I work at Coastline College. Everybody has either a hard copy or an electronic copy of the document. And then what I typically do, I'll make notes in the 4012. So by the end of the season, it's a pretty worn out resource guide. The 4491, I did hear someone mention just before we went hot here that the 4491 is available at the church office. And Mel, I don't know if you want to address that now or you want to wait.
Yeah, we'll just wait towards the end.
Okay, very good, very good. And other documents, of course, like anything, before you take a quiz or an examination, there has to be some type of instruction. And that instruction can be a lecture, it could be an online thing, or perhaps a resource where you're going to read. So before you start certifying in the VITA program, you have to get spun up on the volunteer standards of conduct, essentially the ethics training. And there is a resource for that. That's the IRS publication 4961. And then, of course, the next quiz or certification you're going to take is the intake and interview, and that's at publication 5101. I checked yesterday in the afternoon, and the certification for tax year 2024 is not available. And so when it does become available, you're able to jump in there. Once you obviously review the resource documents, you're able then to take the certification. If you're new or newer, the volunteer standards of conduct and the intake interview, once you review those documents that we're talking about here, you're able to take those certifications, and it's going to probably take you maybe 15, 20 minutes at that to take the certification. Of course, now the basic certification is going to take a little bit longer because you're obviously going to be answering questions regarding tax law, and you'll be preparing a few returns to, again, take that certification. The basic certification usually will take anywhere, it depends on, again, your level of experience and skill, anywhere from maybe, I think takes me maybe 15 or 20 minutes to knock it out. But if you're newer, it may take you an hour and a half or 2 hours, something like that. This is important. I mentioned this last week. Your certifications are open book and self-paced. So you literally can take just all the time you need to go ahead and look up the various questions the answers to the questions, and again, be successful. And you have to get 80% on the certifications to pass. And this is really important when you start certifying in VITA. You want to make sure you look at the answers, because if you're unsuccessful the first time, then you're given one more time to take it electronically. So again, look at the answers. I do that. I mean, I've been doing taxes for many, many years. And when I'm taking the certification, if I'm not sure of a particular question, I'll get into the 4012. I'll look it up and then be successful. Other things, if you are a member of the California Tax Education Council, or if you are an enrolled agent, or if you're a CPA and you want continuing education credits, then what happens is you participate in the VITA program, either as a preparer or a quality reviewer, or in some cases, a tax law instructor. And then what happens is you can earn continuing education credits. And let's see, I think that's probably about all we need to talk about on this screen. And then the next screen, a lot of times you may be spending time reviewing the instructions to the Form 1040. And again, that's just another resource item. And this is important about the Form 1040 instructions. It has tax tables and schedules. And what I've seen at the VITA site in my practice, sometimes taxpayers will ask me, Jerry, how are you sure that the tax that's been computed by the software is correct? And I said, well, we can double check it if you want. So we'll go to the tax tables in the instructions. We'll say, here's your filing status, here's your taxable income, and this is the amount of your individual income tax that you have to pay. And so again, that's something to helpful. If you're newer, sometimes you want to reference the instructions, and that kind of gives you a frame of reference. And then there are many different schedules. It's not like you have to memorize the schedules. You're going to become very familiar with the schedule 1, 2, and 3. And then, of course, the various schedules, the letter ones. Schedule A, you'll see that a lot, itemized deductions. Schedule C, that's going to be typically a small business. And the scope and in-scope that we talked about, there's certain businesses that we do not assist taxpayers with. If they're an incorporated entity, we will not assist them. That's out of scope. We're not trained to do that. If they are a partnership, that's out of scope. We're not trained to do that. And when you're talking about tax returns, there's many different types of tax returns, and there's a lot of things that we don't do. And I think my wife says it best. You would not go to a brake mechanic who is untrained in your brakes on your vehicle. You wouldn't do that because they don't know how to do it. So you go to people who are trained, and we are trained in a certain amount of tax, if you will, or certain types of returns. And our focus is the 1040 and the 540 for California. When you hear the term 1040 SR, what that means is your taxpayer, if they're seniors, then the software is going to generate a 1040 SR. So it's either the 1040 or the 1040 SR. And of course, that'll be generated based on the age of the taxpayer. And that's one piece of data that we do get from taxpayers, their age, their date of birth. And then the Schedule D is in Delta. We will see a lot of this because there's a lot of folks who have capital assets, which we'll talk about. They sell them. It could be stocks in a corporation. It could be maybe their mutual fund shares, or perhaps maybe their personal residence, which is considered a capital asset. And then self-employment tax, something you don't have to remember, you don't have to memorize it, I should say. But self-employment tax is paid by self-employed individuals, and that's computed automatically by the software. And then here's a big one. You'll see this at the VITA site, the 1098 mortgage interest statement. This is an information return. And if you have a home and you have a loan on your home, then chances are your mortgage company is going to send you a 1098 at the end of the year. And that has information pertaining to the interest that you've paid the mortgage company. And it may have other information on it, such as property tax that's been paid. Perhaps maybe you've got an impound situation. But again, the 1098 is an important document that you'll see again and again at the VITA site. Okay, again, a lot of documents, and if you're newer, do not be intimidated by these documents because most of these documents are pretty easy to understand, pretty easy to read. And if you need to get spun up on one of these information returns, your publication 4012 does a really good job. And so things that you're going to see at the VITA site again and again will be that 1099B as in Bravo. And so think of someone who has sold stock. They're going to come to the VITA site and they're going to have a 1099B. And this is something I've learned over the many years. 1099Bs sometimes are very clear, easy to understand, and sometimes they're cryptic in nature. And so in my tax practice, I'll have clients give me a 1099B. I read it and I'll ask them, you know something? I don't know what your broker's trying to tell you. And sometimes I have to reach out to the brokers, of course, getting permission from the taxpayer. But typically the 1099B that you receive at the VITA site is going to tell the story as far as someone selling a capital asset, of course, the date of the sale, the date of the purchase of the asset, and then of course the purchase price and the sales price. Other documents that you're going to see from time to time, and this is really important if you're new or newer. You'll have people provide you with one of these information returns. For example, the 1099 MISC, miscellaneous income. And this is an important thing about these information returns. They may evidence all of the income that someone received, or they may evidence a portion of the income. And so what we'll learn in the VITA program, what we learn in that intake and interview portion is asking those open-ended questions. Tell me about all of your income sources. And then what you will do as a intake or a greeter or a quality reviewer or preparer, you'll make a determination what's taxable, what's not taxable. But again, that's really important because sometimes taxpayers think that the 1099 that they receive evidences all of the income. And then during the interview, you determine it evidences a portion of the income. And then a lot of times you'll see a 1099 NEC, and that's non-employee compensation. Very, very, well, let me restate that. I think you will see that from time to time because people will be issued a 1099 NEC. They're not employees and they're working perhaps for themselves. And then there's a requirement for the individual that pay them to issue a 1099 NEC to them. And all of these documents, they're called information returns because they have information. And then another thing that you may see from time to time, this is typically for someone who's a little bit more experienced. When an individual has sold their primary residence, then of course, a lot of times they're going to be issued a 1099 S's and Sierra, and then you'll take that, ask some follow-up questions, get information regarding the settlement statement, and then be able to determine capital gains on the sale of a primary residence. If you're new or newer to VITA, we do not prepare returns for rental property. If someone has sold rental property, that is outside the scope of the VITA program. And then what will happen a lot of times, taxpayers will say, okay, if it's outside of the scope, what do I do? Well, the taxpayer has options, and we all have options. And one of the options is you can do it yourself, or you can go out in town. You can find yourself a tax preparer. And we do not recommend tax preparers. I'm not going to say go out in town and see Maria or see Robert out in town. You may give them what I do. I give them a reference to a website, maybe the Enrolled Agent Society of Orange County, or maybe the California Society of Tax Consultants, and then they can pick and choose their preparer. And then yes, preparers do charge, and sometimes it is a modest price. And sometimes it could be something that is maybe a showstopper for the taxpayer. It just depends. But again, if it's outside of scope, we cannot assist them. And then here's a big one, the 6744. And I mentioned this and I'll mention it again. When you take the certifications in the VITA program, you can do it a number of ways, but I highly recommend to utilize the 6744, which has the questions which are very similar to the questions you're going to see on the electronic test. And so what I do is before I certify, I sit down with my 6744, I'll look up the question, I'll go ahead and look at the answer, and I'll populate the 6744 with pen and ink, and then I'll sit down in front of a computer and I'll take the electronic test, and I've got all my questions and answers in my 6744. And of course, I've got a record of it. But again, I think that's the way to do business. If you try to sit down and take the certifications without doing the 6744, what happens? You may lose your place, you may get frustrated. That's, I think, the way to do business. And I've been doing that for many years and it works. A couple of documents you're going to see again and again is the intake and interview sheet. And I think it was last week or the week before, I talked to one of the IRS employees who helped us out in the VITA program. And the 13614C, which is the intake and interview sheet, also you can call it a lead sheet. This has yet to be published by the IRS for the current tax year, which is tax year 2024. But again, that's the lead sheet. It's changed significantly from last year. And again, it's used for every single return. And then you have VITA sites that have what is called a local sheet, and St. Killian's has a local sheet. And these are used to make sure that you're preparing a return that's complete and accurate. And then the volunteer standards of conduct, this is something that your site coordinator will ask you to send them. When you certify, the 13615 is going to be within the Lincoln Learn program. And then as you certify, there'll be an auto population. So all you have to do is just access the 13615 when you're done certifying. And then, of course, you'll give that to your site coordinator. That is a contract or an agreement, if you will. And on page 2 of that agreement, it has all of your certification levels. It has the administrative data, your name, your contact information. And then if you are a tax professional and you want continuing education credit, then what happens is you're going to populate the Lincoln Learn with your enroll agent number, your CTEC number, whatever the case is, so you can get CE credit. I'm going to hesitate for a moment and let's see, do we have any questions from the participants? And Damien, I don't know if you're moderating that.
I am. Mel answered a couple of questions regarding when they need to be certified. There were a couple of questions about the PowerPoint slides. These PowerPoint slides will be sent out after, correct?
Yes, they were sent out a few days ago, and if you need me to resend them, just let me know.
All right, so they might be in your email.
Okay.
Yes,
All right, very good.
I don't think they were sent to everyone. So I got one from Adela personally because I asked, but they were supposed to be sent out a few days after Sean did, and I guess it didn't happen. But Adela has them.
Okay. Yeah, and whether it is Adela or Mel, whoever is the proponent, if you will, then yeah, they can send them out. And then if anybody needs them, they can contact Mel or one of the other officials or leaders, if you will, and then we can get that sent out to the individual.
Yeah. And then, yeah, go for it.
Jerry, this is Fred.
Yes.
The recorded training are now on the St. Killian website and can be accessed to St. Killian, which I believe Sean has disseminated to some, I guess not to everybody else, but you can access it on St. Killian website if you just Google St. Killian.
All right, very good. Thank you. Thank you, Fred.
Do you want me to
Okay.
post the link to that?
Go ahead, Damien.
You want me to post a link to that previous?
Oh,
in the
please,
chat?
yes, and get that information out, yes.
I will get that. Thank you. That's
All
it.
right, thanks. We'll move on. And then, of course,
This is a Sung Ho, so I don't have that paper. Could you send me that?
sure, you want to go offline and talk to either Damien or Mel?
Okay.
Okay. So let's talk about California a little bit. Our focus right now is obviously on the federal return. When you prepare a tax return in the VITA program, obviously you're preparing a federal return. And generally, when you have a requirement to file a federal return, you generally have a requirement to file a California return. So the software is going to generate a federal and a state return. And the state return, a lot of times you're not going to be making any changes to it, if you will, but sometimes you have to jump into the state return, which you're going to do not in this session, but in a later session, and you've got to make some changes. And so that's just the way it is because the state of California has a completely different system. I like to use the analogy, you think of the federal government as a dog and the state of California as a cat, two different species, and so you have to sometimes get into the California return and perfect it or make certain changes to it. Here's a couple things that you'll see at the VITA site. When people sell real property, i.e. their home in California, they typically are going to go through an escrow, and then typically they're going to be issued the Franchise Tax Board Form 593, and it has information regarding withholding requirements. So when you sell your home, generally there's a withholding requirement, which means the escrow companies are going to go ahead and take a little bit out of the proceeds and they remit those withholdings to the state of California. And then when you file a state tax return, then you're going to record or you're going to report that withholding amount. And sometimes you get some of it back, and sometimes you have to pay some extra. It just depends. And then, of course, here's another thing that you'll see for just about every taxpayer in California. If you're a resident, the general rule is you have to have health insurance. And there's many ways to get health insurance. You can get health insurance through your job if your employer offers it. If you're a senior, you can get health insurance by signing up for Medicare. If you're a veteran, you can get health insurance at the Veterans Administration. If you're self-employed, you can pick up the telephone, call an insurance company, and sign up for private health insurance. Of course, it might cost you a little bit, but there's different ways to get health insurance. So the general rule is you got to have health insurance, and if you don't in California, then you may be subject to a penalty for California, and that's the individual share responsibility penalty. The federal government does no longer has the individual share responsibility penalty. And we will talk about insurance when we're talking about Covered California. That's a big thing that you're going to see at the VITA site. And then the instructions, again, there are many different types of state publications, and one publication is the instructions of the Form 540. Very helpful. Okay, this is kind of geeky, if you will, but I just throw this in because a lot of times when you're talking to people, they're wondering where you get your authority. Well, you get your authority by becoming a certified VITA volunteer. And then, of course, that authority, your site coordinator has authority. And of course, the IRS has authority. But when you're talking about the federal government has tax laws. They're passed in Congress, signed by the president. And this is the one I always refer to when people ask me, well, Jerry, is this included in my income? And I always tell them that everything's included in gross income unless it's excluded. And so what I do as a tax person, when someone pitches me a fact pattern and say, Jerry, this is the income that I had, I automatically say, okay, unless we can find an exception to that, that income is going to be included in gross income. And of course, obviously, there are many exceptions. One example, for example, is when people borrow money. If you borrow money, whether you borrow $500 or $500 million, when you borrow money, there's no tax consequence. And you'll see people that come to the VITA site and say, well, I got a gift, I have an inheritance, I borrowed money, and there's certain things that are not included in gross income, which means we'll definitely talk to them and we'll explain to them once they give us the fact pattern, once we develop the fact pattern, I'll tell them that that particular income is not subject to federal income tax. And then we'll talk about what is called the exclusion of the gain of the sale of a personal residence. So when you sell your house, if you qualify, what happens is you can exclude a certain amount of that gain from the sale of a principal residence. And then you will hear me use the term capital asset. And when we're talking about capital assets, typically you're going to, at the VITA site, these will be shares in a corporation. Someone comes in, they've sold shares that they have through their brokerage. In fact, I had a young man that came to my office the other day, and he had sold some capital assets, and then of course it was retained within the brokerage house, if you will. And he did not know that once he sold them, he had to recognize a gain. So I explained to them, yes, once you sell a capital asset, and we'll define a capital asset, and you have a gain, or maybe sometimes you got a loss. But again, you want to report that. This is something that, again, if you're new or newer, the Lincoln Learn Taxes, this is where you certify. And in fact, I'm teaching a class right now at a college, and a lot of my students are, for lack of a better term, they're frustrated because the IRS has not launched the Lincoln Learn certification for tax year 2024. And so I tell my students, I got it. If it's not launched, it's not launched. But what you can do in the meantime, you can review some of the materials. You can review that publication 4012. That is your go-to document to get spun up on the tax law and spun up on the software, if you will. And then you also have the advantage of going into the practice lab, the software, and navigating through that and exploring it, and then doing some returns, if you will, practice returns. And then you'll find once you have that knowledge, getting the certification completed is usually very quick. But again, don't get frustrated. When the IRS launches the Lincoln Learn certification, you're able to jump in there. Now we're looking at, I think this is November 9th, if my math is right. And Mel, I think your VITA volunteers have to get the certification to you, what, mid-January, I think?
Yeah, we always say around January 20 because we're opening the site last week of January.
Yeah, yeah. So you got plenty of time. Like for the folks that work for me at my college, I tell them if you want to show up the first day with your certifications in hand at 13615, I'm okay with that. But the bottom line is you got plenty of time to certify, and so don't get frustrated. When it opens, it opens. And then I did check, and yes, the 2024 tax software or tax year software is available. And I like to use the term work in progress, which means it's been posted to Lincoln Learn. It's not perfect. The state returns are not there. And so what will happen is the IRS and the software folks, they're going to go ahead and get things figured out. But yes, the 2024 is available right now. Okay, let's talk about some income items. When you're talking about Social Security, there's the most people that you bump into, most seniors, not all of them, receive Social Security. And anything in life, whether you want to buy a candy bar at a grocery store or you want to get Social Security benefits, everything in life, you got to qualify. And so, for example, my former boss, she will never receive Social Security benefits. She receives a federal retirement because she did not qualify for Social Security. But when you're talking about Social Security, there's a description in the 4012 that talks about Social Security benefits. And the document that the seniors are going to bring in is going to be that IRS form SSA 1099. And this is the takeaway from the 1099. It's going to have the Social Security benefits that was paid out to the senior. And if they're on Medicare, and the vast majority of seniors are on Medicare, it'll show the Medicare premiums that the individual paid. And then sometimes, and I've seen this not that often at the VITA site, but it's in scope, and so you want to have an awareness of it, you have what are called lump sum payments. So I had a taxpayer at our VITA site a couple of years ago, she finally got paid out her Social Security for like 4 or 5 years. And the lump sum, of course, you have to attend to that in the software. And the publication 4012 talks about that lump sum payment and how obviously it's taxed. But the publication, the IRS publication 915, that is your go-to document for Social Security benefits. And typically it's not that difficult. You'll key it as you see it in the software based on the SSA 1099. And then retirement income, you see a lot of this, and that 1099-R, that's an information return. Typically what you're going to see is individuals either have a pension or they have some type of payout from a tax deferred savings program like a 401k. And when you hear that term 401k, if you actually get into the tax law and you get into Internal Revenue Code section 401k, it talks about tax deferred programs. And then here's something, if you're newer, you'll bump into this every once in a while, and it makes a huge difference in a good way to the taxpayer. Some individuals will have what is called a basis or a cost in their pension. They've made contributions. So what happens when they receive their pension distributions, that cost that they're getting back, if you will, there's no tax consequences to it. And there is a simplified method worksheet in the software, which we're going to show you during this, not this session, but in a later session. So what's really important when someone comes in and they'll know this generally, they'll say, we've got cost or basis in their pension. And we've seen this before. I think probably the best story is I was working with a young guy. He was an accounting major, and he had interviewed a VITA taxpayer. The VITA taxpayer had significant cost or contributions to his pension. And so I sat down and I said, let's go ahead and determine how much that is. And this taxpayer had like $80,000 of cost in his pension. I said, that makes a huge difference. What that means is when you receive your distributions, a big chunk of your distributions are a return of basis, if you will, which is not subject to taxation. So that's a good thing once we determine the cost of the plan. So you will see that. That's one of the questions you want to ask. And typically what happens is you have your senior preparers get involved in that to help out. But again, you'll hear that term simplified method again and again. And it's not that hard. You simply open up the worksheet in the software, you populate it, and then the software is going to say, this is the amount of the distribution that is subject to taxation. And then something that you'll see from time to time, in fact, I saw this, I think it was last year, the year before at St. Killian's, a very generous VITA taxpayer was taking distributions from her retirement, and that distribution went directly to a charitable organization. And it was many, many thousands of dollars. And so what that means is if you have a qualified charitable organization, again, everything in life you got to qualify. When you have that qualified distribution, it goes directly from the plan to the charity. And what that means is the taxpayer is not going to be taxed on that distribution, nor can they take a qualified charitable deduction on their Schedule A. But you will see that from time to time. But it has to be a direct from the company, i.e. the trustee, to the charity. And sometimes the slides freeze, so let me unfreeze this. And then Damien, feel free to jump in if there's any questions or comments. Okay, here's another thing we see at the VITA site from time to time, and it's not pleasant news for taxpayers, but again, when you borrow money, there's no tax consequence. You can borrow whatever you want. But if you don't pay it back, then what Congress says is you've been economically enriched. So think of someone who gets that new credit card and they rack up the bills to the tune of maybe $20,000, and then they are unwilling or unable to pay that $20,000 debt. Eventually what happens, there's a cancellation, and the general rule is that cancellation is going to be subject to taxation. And it's out of scope if the individual has debt discharge in bankruptcy court, which people do. They go to bankruptcy and get some of their debts discharged, or if they're considered insolvent. And when you hear the term insolvent, that means you have negative net worth. And again, this is out of scope. If someone says, hey, I was insolvent, or you ask questions and you determine they are insolvent. But again, typically at the VITA site, you'll have someone who comes in with a 1099-C, that cancellation of debt information return, and they have not paid off maybe a credit card. Let's see, the other things, we'll pass on that. Okay, here's another thing you'll see from time to time, different types of income. And, I don't think I'm the smartest guy when it comes to taxes. I know a little bit, and I bump into taxpayers every single year, VITA taxpayers and taxpayers in my tax practice. And they say, Jerry, I've got this type of income. And we look at it, I call it a fact pattern, and we try to determine if it's taxable or non-taxable. So when someone comes to me and says, Jerry, I've got a prize or I got an award, is this considered taxable? Well, I always default to, well, it's going to be included in gross income unless it's otherwise excluded. And there are certain exclusions when you're talking about prizes and awards. So what I do is I'll jump into that publication 4012, and I may look at that IRS publication 525 to determine if a prize or an award is taxable. And don't be shy. You don't want to be shy with your taxpayers. If you don't know something, just say, I don't know it. I've got clients that I work with all the time, and they say, Jerry, what's the situation here? I said, I don't know. I said, I got to do some research. And sometimes it takes you a minute. I think one time I had a taxpayer. It's a huge case. It took me 30 hours of research, and I finally found the answers. But typically in the VITA program, it's quick. You jump into 4012 and you determine if it's a taxable or non-taxable event. And then something that I'll throw this out, fair market value. Probably the best example I can think of. I had a individual who won a big screen TV, and $1,500, something like that. So the fair market value was about $1,500. We looked it up, and the individual received a 1099 MISC, and the dollar amount on the 1099 was more than $1,500. I think it was like $1,800. Well, I told them, well, this is the rule. If you want to report that $1,800, you're welcome to do so. But the rule is you only have to report the fair market value of that particular item. So we looked, and this was done contemporaneous. We had information pertaining to a store that sold the same make and model of the big screen TV, and we just reported the fair market value. So that's something that you can do. Again, the requirement is you only have to report fair market value. And then jury duty, you're going to see a lot of this at the VITA site. And when you go to jury duty, it's a very modest pay, if you will, very modest. And so you're going to be paid a small amount of money, and that is considered included in income, that jury duty pay. And you're going to report that in the software. And then this is something that you may see from time to time. I'll use me as an example. When I was a federal government employee, when I was called to jury duty, I'd go to jury duty, I'd report in, get some type of payment, whatever, $20 a day, whatever that is. And then when I was complete with jury duty, I would go to my secretary and hand my IRS secretary my paycheck, my jury duty pay. And so mechanically, this is what I would have to do. Step number one, I'd report the payment. Step number two, I'd report what's called an adjustment to income, because I turned over my check, relinquished my check, and the net effect would be zero. And if you don't have to turn your check over to your secretary at work, i.e. you, let's say you're self-employed and you keep your jury duty pay, then you just go through step number one, reporting the payment. Now, when you're talking about getting some type of reimbursement for your travel to the courthouse, that is not subject to taxation. It's a reimbursement. Okay, this is something, and I think I've learned over the years, and some of my students have actually pointed this out. when you're talking about getting some type of K1, a K1 is information return. And when you see the forms 1065, that's a partnership return. The 1120S is a corporate return. And then the 1041 is an estate or trust return. So sometimes what will happen, taxpayers will bring in what is called a Schedule K1. So we're not going to prepare those returns that I just mentioned, but the K1 that they receive and someone else has prepared the return, and then the taxpayers received a K1, we will use that K1 and take certain items off that K1 and input it into the software, i.e. it's in scope. And so these are the various items that will be in scope. And of course, your go-to document for the K1 is the publication 4012, and that's page D as in Delta 59. So again, these are items that are in scope. And if you're ever in doubt about what's in scope or out of scope, you go to your publication 4012, and sometimes you'll have a quick discussion and you'll make a determination. This is within scope. We can handle this. And if you are a greeter or an interviewer, you want to make sure that you have a working knowledge of what's in scope and out of scope. And you can avoid a lot of frustration and a lot of angst where you can tell the taxpayer straight away up front, your return that you want us to do is out of scope for the VITA program. So you're going to have to go somewhere else. And that's why it's so important. Whoever you put in as a greeter, they've got to have a lot of knowledge. Typically what I like to do in my site, I like to get one of the most experienced folks to be a greeter. And then that way we avoid a lot of issues with returns coming to preparers that are out of scope. And then we have to go and tell the taxpayer, sorry, we can't help you. Okay, itemized deductions, we'll run through these. When you hear the term itemized deductions on the tax return, you can get a deduction, and this is the general rule. You can get a deduction, and that could be a standard deduction, which is provided for statutorily, or you can get an itemized deduction, and typically you're going to take the greater of. And so you might have someone who comes in and say, I've got all these various expenses, and those expenses are itemized. They go on the Schedule A as an alpha, and then we can take that on the return and obviously reduce their taxable income. So when you're talking about medical and dental expenses, I don't think I've met a person yet who hasn't paid for some type of medical or dental. And so you want to use that term out-of-pocket expenses. So if you've gone to the doctor and you've signed up for an appointment and they say, okay, the doctor will see you now, but you got to pay, let's say $20 or $25. Sometimes the term copay is used. And so that would be an out-of-pocket expense. Or like I'll use me, for example. So I went to the doctor. Doctor says, Jerry, you got to take this medication. Okay, great. Go to the pharmacy. Go up to the pharmacy. They go, hey, this medication is whatever, $50. I pay out of pocket, and that's something that's included in medical and dental expenses. Like I went to the dentist the other day. I think they call it a deep cleaning, and I have dental insurance. And of course, when I pay my dental insurance, that's out of pocket expenses. And then the dentist charged me for that deep cleaning, a portion because I still have dental insurance, out of pocket expenses. The medical miles, this is something when you drive to the hospital, when you drive to the dentist, you can take 21 cents per mile for that as far as your medical and dental expense. But again, the concept is your out-of-pocket expenses, meaning you're paying whether it's insurance premiums. And so, for example, let's say you're a senior and you're on Medicare. You're paying Medicare insurance premiums, and that's considered an out-of-pocket expense. If you add up all your expenses and it ends up on your Schedule A, you can take that tax benefit. This is something you'll see a lot of. You have people who have prescription eyeglasses. You have a lot of people that have hearing aids. You have people who have like my next door neighbor has a nurse that comes in to visit his wife. And so these are expenses that you're going to incur, again, out of pocket. And then you're going to get this from time to time. People will say, well, I've got these particular expenses, And are these deductible? You'll get the fact pattern. And for example, teeth whitening, that's not deductible. And a lot of people have cosmetic surgery. In fact, this is very popular, very popular. And so the general rule is, and there are exceptions to the general rule, the general rule is cosmetic surgery is not a deductible item. And then, of course, there's a however, and those howevers are listed in that publication 502. And then another item that is on the Schedule A are your state and local taxes. And so when you're talking about state taxes, think of if you're a wage earner, most likely you're going to have monies withheld from your paycheck, and that would be state tax withheld, and you probably even have federal tax withheld. On the Schedule A, your state tax withheld, that's something that will be populated, again, if you have monies withheld from your paycheck. And then when you're talking about if you're looking at the screen here, you can take state tax withheld, local tax withheld, or what is called a sales tax deduction. And you may see that. So this is an option that you have, and you have to get into the software and dig down there to determine if that state sales tax deduction is greater than the state tax withheld. And then you may have heard of the term SALT, which is state and local taxes. You typically don't see this in the VITA program, but there is a statutory limit, and your limit is $10,000 in the Schedule A for state and local taxes. And then a big one for people who are homeowners. Most people pay their property tax. If they don't, usually there are bad consequences. And so the taxpayers are going to come into the VITA site with their Orange County property tax bill. And that's the real property tax that they pay that they can deduct. And then here's another thing. Most individuals have an automobile, and most people have the vehicle registered, and so they're paying personal property tax to the DMV. And that's something that could also be listed on the Schedule A. All right, we'll kind of take a quick hesitation here. Okay, I think we can get through this, then we'll take our first break. When you're talking about the home mortgage interest, not everybody has a home loan, but a lot of people do if they have a house. And when they have a home loan, there are certain limitations to the home mortgage interest that they pay. But generally, what you're going to see at the VITA site, people will come in with that 1098, and they're going to be able to deduct generally all of the interest that they pay to their mortgage company. And so again, it's listed on the 1098. And then you're going to hear this term again and again. You're going to key it as you see it. So when you have an information return, this is the general rule. You're going to enter that data into the software as you see it on that information return. And then another thing that you'll see, and this is for seniors, if I remember correctly, I think you have to be 62 years of age or older to get a reverse mortgage. And a lot of people do. And if you get a reverse mortgage, good for you, but it's considered a loan. And so that means when you borrow money, again, it doesn't matter how much you borrow, there's no tax consequences. Now, when you don't pay it back, then there's a tax consequence. But when someone has a reverse mortgage, it's a loan, and that's not going to be taxed. And then points, this is something when you borrow money to buy a house, typically you're paying the fees or points. And this is the general rule. The general rule is you're going to amortize those points. So here's an example. Let's say you get a loan and you pay $3,000 in points. And let's say your loan happens to be a 30-year term. Well, you take that 3,000 divided by 30, you end up with a $100 a year deduction. And you're thinking, well, that's not enough. I want more than that. Well, if you want to deduct it in full, then that's the exception to the general rule. And you can deduct those points. And you'll see that people purchasing new homes, and they're paying points because obviously that's charged by the lender. Okay, I think this, Damien, I think this might be a good time to take a break. I've got just before 10 o'clock, and so you want to take 10 minutes?
Yep, I do not see any questions. We'll pause the recording. All right, we are recording. Thank you, everybody. Resume the training, Jerry.
Okay, very good. All right, we're going to jump into charitable contributions, and you will see this a lot at VITA sites. Thankfully, a lot of people are very generous, and you'll see the VITA clients at St. Killian's. They'll donate to either St. Killian's or some other type of charitable organization. And so when you talk about charitable contributions, this is probably one of, in addition to your 4012, this is another go-to document. And you'll hear the term qualified charitable organizations. And sometimes, and we actually saw this at a VITA site a number of years ago, where we had a very generous VITA client who donated, I think, almost $8,000 to a charity. And then we had to explain to this VITA client that charity was not a qualified charitable organization, which means the taxpayer, I'm sure, did good things, but was not able to take a tax deduction because it was not a qualified charitable organization. And so when you're talking about charitable contributions, that's described on page F as in Foxtrot 16, the Pub 4012. And again, you're looking for a qualified charitable organization. If in doubt, then you would go ahead and do the deep dive. There's a search tool. You can see the URL on the screen. And the IRS has a laundry list, a very long laundry list of all of the organizations that have requested tax exempt status. And so in order to become tax exempt, that means you have to take an affirmative step, which means you've got to apply to the IRS for that determination. And so sometimes you'll have certain churches, not many, but certain churches, they want nothing to do with the federal government. They want nothing to do with the state government, and they're on their own. And so they're not tax exempt. They can call themselves a church. The holy man or woman can go ahead and self-anoint themselves, and they can do what they want because it is a free country. But again, they're not going to have that tax exempt status. And then this is something that you'll see typically on letters. Like when I've donated in the past, the charity will send a letter to me, and there'll be some type of tax identification number on the letter. And it'll say, "Dear Jerry, thank you for your donation of this, that, whatever, and here's our address, and here's our tax ID number." Again, that would be for a qualified charitable organization. And then when you're donating to a charity, a lot of people, they will donate cash or what we call cash equivalent, maybe a Zelle payment. It could be a negotiable instrument. It could be currency. But again, those are cash payments. And then there are non-cash payments. And non-cash payments, let's say you're donating maybe cans of corns or cans of pea or something like that to a food bank. That would be an example of a non-cash contribution. I've donated couches, I think a refrigerator one time, some chairs. I think I donated some clothing. Typically, of course, your qualified charitable organization wants something that's serviceable so they can go ahead and sell it and support their operations. And then you have non-cash contributions, again, various different types. And in the VITA program, we're limited. And so if you have someone like I had an individual who donated $30,000 worth of books to a college. And that was a non-cash contribution, but clearly outside of the scope of the VITA program. And then if you're driving around for charitable work, and a lot of people do, Meals on Wheels, stuff like that, and they're not reimbursed, and then they can take a 14 cents a mile for the driving around that they do, in addition to parking and tolls. So you'll see that from time to time. And of course, what the taxpayer wants to do, they want to have some type of accounting for the miles that they drove. If they don't, then what I would do at a VITA site, I would ask them, how many trips did you take? What was the average length of each trip? And then you go ahead and do the math to determine, again, the amount of charitable contribution. All right, and this is kind of a rehash of what we just looked at. This is usually not an issue, but when it does become an issue, then of course it's a significant thing. As I mentioned, that lady who donated $8,000. But you can find tax exempt organizations. You can do the deep dive, and there are thousands and thousands and thousands of them. And of course, the IRS maintains that list, and you can just jump into the IRS website if there's any question about it. Typically, they being the taxpayers, they'll say, I donated X number of dollars to this organization. There'll be a tax exempt number on it, and then we'll take that at face value. Okay, and then here's some examples of qualified charitable organizations. Most churches and houses of worship, most. Of course, again, they have to go through a process to get a determination if they're qualified. And then sometimes you've got certain nonprofits that are obviously qualified. And then the charities that you might be familiar with, United Way, Red Cross, Salvation Army, Goodwill, those are qualified charitable organizations. And then when you're talking about donating, if you've ever taken financial accounting, you're going to hear the term cash. Well, cash means currency, green dollar bills, it includes coins. If you make a direct debit or a Zelle payment, or if you have some type of negotiable instrument, a check or a postal money order, and you donate that, well, that's considered cash. And so that would be something that you can take a deduction for a qualified organization. And then sometimes you're going to have individuals who go to some type of convention, a church convention, and they're unreimbursed for expenses. And if that church is a qualified organization, then that would be a qualified donation. All right, now we talked a little bit about qualified charitable distributions. So probably the key takeaway here, and I saw this, I think this was last year, the year before at St. Killian's. A very generous woman. She donated a lot of money. And what we did is we made a determination. The donation came directly from the trustee from her retirement account and was paid directly to the qualified charitable organization. And so that would become a qualified charitable distribution, which means she's not going to be taxed on her distribution, nor can she take a qualified charitable organization, a qualified charitable deduction. So you may see that from time to time. And then non-deductible charitable contributions. You'll see this all the time. What happens, and I'm the same. I'm probably like just about everybody else. You get things in your mind, and you think this is the way it is, and then you find out no, that's not the way it is. And so, if you donate money to an individual, I remember one time I was driving back from a coffee shop, and some guy was standing on the corner. And it looked pretty legitimate to me. He was there with his kids. It was Thanksgiving Day. I'm thinking that's a tough time to ask for money. So I gave him a little bit of money, and then of course my son asked me, "Hey, is that a charitable deduction?" I said, "No, it's not. When you donate to an individual, you cannot take a deduction on your tax return." And my sister used to make sandwiches for homeless folks up in the Los Angeles area. And she spent a lot of money doing it, and she would deliver it with some of her friends to a number of homeless individuals. And I guess my sister was doing great stuff. But again, that's not a deductible contribution because those individuals are not a qualified charitable organization. And then other things that you may bump into, there are many different types of lodges, fraternal lodges, like the Moose or the Eagles or the Elks. I think there's probably a couple, two or three others. When you're donating money to their national foundation, then that's going to be a qualified charitable organization. When you're paying dues to your lodge, that is not. You're paying dues to use the lodge, but those are not deductible items. And then other things that are not deducted, and we have people who, thank goodness, they donate blood. That's important. The Red Cross, they do a great job there. But when you donate blood, that is not a charitable contribution. Now, if you drive to the hospital or drive to the Red Cross, then of course you've got your donation miles there that we talked about. But again, you're not going to get a charitable contribution for donating your blood. You can't ascribe a value of $300 per pint. It's not going to work. And then sometimes, and I did this as a youngster, sometimes you have people sell their plasma. Well, when you sell, or I think the term is called donating plasma, And they typically give you, I think they gave us like $10 when I was in college for donating plasma. That's actually considered other income. Yeah, it's not a charitable contribution if you sell your plasma. And then here's another thing about your services. You may think that your services are worth a lot, and maybe they are, but when you donate your services, there's no value to that. So I've donated my services to charitable organizations, and they're not worth anything. I can't assign a value of $200 or $300 an hour. You cannot do that. And then gambling, this is something, if you're new or newer to VITA, this is something that's kind of a trend. I'm not saying it's a bad trend, but it's just a trend. I see more and more people gambling. And I don't know if that's a good thing or a bad thing, but if you're gambling, you have to report your gambling income on your federal tax return. And there's many different types of gambling. A lot of people go to Vegas, and they may go to the some of the Native American casinos, or maybe they go to the horse races or the dog races. But if you win, you have to report that on your tax return. And if you lose, then you can take a deduction up to the amount of your winnings. And this is something you're not going to see in the VITA program. There are people who think they are professional gamblers. And once you talk to them for a few minutes, then you realize they're gamblers, but they're not professional. I've been doing taxes for a very long time. And of course, I don't live in Las Vegas. That might be a different story. I've met maybe 2 or 3 professional gamblers in my time. That's out of scope. We don't work with the professional gamblers in the VITA program. Most of your gamblers you're going to bump into are recreational gamblers. And of course, if you're a recreational gambler, then you're going to report your winnings and you can take your losses up to, again, your gambling winnings. And then this is something, it's not a big deal, but it still benefits a taxpayer. Let's say they come to the VITA site and they paid someone to prepare the return in the previous year. And let's say it's $300 or $400 or $500, something like that. Well, you cannot take a deduction on your federal tax return at present for tax preparation fees. But what you can do on your California itemized deductions, you can go ahead and take a deduction for tax prep fees. And so in the software itself that we use, you'll make the entry in the federal side of the house. And what happens is you're not going to get that deduction on the federal side of the house, but it'll roll over or carry over, if you will, to the itemized deductions on the 540. And again, think of the cat and the dog analogy. California is different than the federal government. California, in a lot of cases, they don't conform to federal tax law. And that's why you can take certain items on your California return that you cannot take on your federal return. All right, let's go to business income. Now, this is something, and this might be a little overwhelming, but we'll go ahead and demystify it. When you're talking about a sole proprietor, you're talking about a VITA client typically that has modest amount of income, 20 or 30 or $40,000, and they have a business that there's a lot of things that we simply don't attend to in the VITA program. So we're going to talk about what we would accept as a VITA client if they're self-employed. And this is the big one. When you're talking about someone who is a cash method taxpayer, that's all we work with in VITA. When you hear the term cash method, it simply means this. They're going to report their income that they received in tax year 2024. And they're generally going to deduct their expenses that they paid in tax year 2024. And that's the taxpayer that we're going to be working with, the cash method taxpayer. And then in the VITA program, we do not calculate depreciation. So if someone's self-employed and they have some type of business asset, a machine, or maybe an automobile they use for business, we do not calculate depreciation. That is outside the scope of VITA. And again, if the taxpayer says, well, where do I go? I do have items that I need to depreciate. And the answer is you'll have to go out in town. You'll have to find yourself a professional tax preparer. And then, of course, you'll have to pay them to prepare your return. Again, there's certain things that are just outside of the scope. This overview is the publication 334, which if you are a small business owner, it's a great publication to take and to review. It is user-friendly and it gives you a lot of great ideas what you need to do to be compliant for federal tax purposes. When you hear the term sole proprietor, that means the guy or the gal who's in charge for that business. And a lot of your sole proprietors, it's just them. Now, if they have employees, we don't help them in the VITA program. That's outside of the scope of VITA. So typically our VITA client comes in, they may be a dog walker, they may be a courier or some kind, and it's them, themselves, and them. Again, they're a sole proprietor. And then you're going to hear various terms, and that's one thing I guess that's great about the English language. There's many terms that mean the exact same thing. And so when you hear the term, here's my income statement, it simply means your revenue, i.e. what you received, and your expenses. Or some people will use the acronym P&L, which is profit and loss statement. It's the same thing as an income statement. Or sometimes they're going to say, I've got an operating statement. It's the same thing as an income statement. And so when people come to the VITA site and they're self-employed, you want to focus in on what do they receive as far as income and what are their expenses. And then sometimes it's a little bit, I have to ask them a few questions because quite frankly, there's a lot of people who are not meticulous in record keeping. And so sometimes you got to ask them, hey, how can we get that information regarding the income? Did you have deposits to your bank account? How did you document your income? And then again, as I mentioned before, the 1099 NEC, that is an information return which may evidence some, or it might evidence all of their income. But again, it begs the question, when someone gives me a 1099 NEC, one of the first questions I ask them, does this evidence all of your income for this particular business? And if they say, yes, it does, okay, very well. Or no, it doesn't. And of course, okay, then tell me about the rest of your income. We're not going to talk about all this because a lot of the stuff you're just not going to see in the VITA program. So again, when you're talking about self-employment, we use the Schedule C as in Charlie. And usually it's a very quick, we'll show you before we conclude today. It's very quick when you're going to enter the data in the software. And then what will happen, the software will calculate the net income. But typically you're looking at gross receipts. And again, that's going to be defined as all of the income that they received in tax year 2024 for this particular business. And then this is something, you'll see it from time to time at the VITA site. Usually it's not a big discussion, but sometimes you may have to educate the taxpayer. When you're talking about someone who's self-employed, if they're deducting expenses, the expenses have to be what are called ordinary and necessary. It's got to be a business purpose, and it has to be reasonable in an amount. So I'll use an example. Let's say you have a VITA client that comes in and they're a dog walker, and they have people who want their dogs to be walked. Maybe they're on vacation or at work. Well, then the dog walker, self-employed, may have certain expenses. Maybe they buy leashes or maybe doggy bones to keep the dogs happy. Certain types of items. And so again, what's ordinary and necessary for dog walking? I always use the example, let's say you have someone who's self-employed, pick a business, any business, and they decide they're going to have a birthday party for their 9-year-old daughter. So they get the bouncy house, they hire the clown to come in, they invite all of the kids in the neighborhood, and they have this great birthday party for their daughter. Well, that's fine, but that is not going to be a business expense. That is a personal and family living expense, which is not allowed. And you'll see certain individuals who say, well, I've got this expense, and all you got to do is say, well, is it ordinary, necessary, is there business purpose, and is it reasonable in amount? And if it meets those tests, it's deducted on their Schedule C. Other things that you're going to see, education. This is very common. It depends on the line of work. I'll use me as an example. So I'm I'm a former IRS guy. I'm a practitioner. And then as a practitioner, I have to go to continuing education. And so I pay for continuing education, whether it's done via Zoom or face-to-face. And the CSTC, that's the California Society of Tax Consultants, that's the organization that I belong to. And so I have to pay for certain classes. And that would be part of my education, maintaining my skills as a tax person. And that's something that I can deduct on my Schedule C. And then sometimes people give gifts, and if you want to give gifts, so be it. But for tax purposes, there's a limitation when you're giving gifts to your clients. And so, for example, I work with a guy, and his claim to fame is he will give out these. This is during the holidays to appreciate his clients. He gives them pecan pies or pumpkin pies, and they're really good. But again, it's a gift, and he can take a deduction on his return, but again, up to $25 per gift, and there's other requirements. So you may see that from time to time.
Hey, Jerry, we have a question
Okay.
from Bruce. For sole proprietors, if they pay contractors, would that be an out of scope, like having actual employees?
No, because when you're talking, I don't believe so. No, when you're talking about an independent contractor, they're not considered an employee. If you have a self-employed individual who happens to have employees, that is outside of the scope of VITA. We do not assist them. So they'll go out in town. Now, if you have employees, then that begs the question, okay, number one, are you paying them? And if you are paying them, are you withholding? Because there's certain requirements that you have to withhold, federal and state taxes. There's certain payroll taxes that you have to pay. And so that's outside of the scope. And I always tell clients who want me to do their payroll, I tell them, I can do that, but it's going to be very expensive to you. So go find a payroll service, and that's what they specialize in. But no, we won't help someone who has an employee or employees. Now, this is probably good news when you're talking about certain things that are out of scope. Depreciation's out of scope. And for tax purposes, we can use the term cost recovery. We don't do that in the VITA program. Now, if you go to certain VITA sites and you have individuals who are certified at the military level, then what will happen is if you have someone who has rental property and that taxpayer brings in the amount of the depreciation expense, then we will enter that into the software, but we will not calculate depreciation. It's outside of the scope, non-negotiable. We just don't calculate it. When you see the term depletion, that means it's cost recovery of natural resources, and then amortization is cost recovery of intangible property. But again, outside of the scope. And probably the big one, and this is more of an education thing. I mean, we all get educated, whether we're 21 or 81, and substantiation. We're not auditors at the VITA site, but we're going to encourage taxpayers to substantiate, maintain their records. That's very important because in the unlikely event they get audited by the IRS, IRS is going to ask certain questions. They're going to ask for substantiation. So you want to keep that. And then this is a very detailed discussion of phone expense. I'll just give you kind of the quick and easy thing here. When someone has a cellular telephone, and just about everybody I know, in fact, everybody I know, in fact, the one guy I knew who didn't have a cell phone, I met him recently, and he did get a cell phone. I think he was 65 or 66 years of age, and he finally got a cell phone. But anyway, if you have a phone and you're using for your business, then that's something obviously you can deduct in your Schedule C. I'll use me as an example. I have one cellular telephone. I use it to call friends, family members, any business I need to deal with. I use it for my tax clients in my tax business. I use it for my VITA clients, and I use it for my college students that I talk to. And so I, as a tax practitioner, cannot deduct my one cell phone on my tax return because I don't have an itemized list of my business calls. And so when people say I've got a cell phone, I'm paying $60 a month, thinking, well, if you got an itemized list, we can determine the business expenses. We can deduct that on the Schedule C. But if you don't, if you're like me and you're paying that $70 or $80 a month flat fee, you're not going to be able to deduct that. And there's case law in that. And so when I talk to either practitioners or VITA clients, I tell them, chances are you're not going to be able to deduct that. But again, develop the fact pattern. And so people can say, yes, I can itemize, and I've done that, and here's the information. Okay, then you may be able to take essentially an allocation, if you will, of your cell phone bill. But don't get into the habit when someone says, I got a cell phone, I pay $70 a month, and then I paid for the entire year. Just don't enter that data as a cell phone expense on the Schedule C, because if they have the one cell phone, obviously then either there's an allocation or they're not going to be allowed to take the deduction. All right, other things are out of scope. If someone comes to the VITA site and says, I've got a jewelry shop, I've got a shoe shop, and I've got cost of goods sold, i.e. I purchase items, got inventory, the answer is that's out of scope. We can't help you. And so those are things that we won't address in the VITA program. Because when you talk about taxation, if you talk to a tax professional, it doesn't matter what type of returns they prepare. The tax world is huge. There's a lot of things to consider, and there is no way you can take someone in a short period of time and have them master the taxes. And that's what VITA is all about. It's a very short training period, and we only attend to those basic returns. And sometimes it's frustrating for taxpayers, but again, you just tell them, hey, we are only trained on certain items, so we prepare basic returns. If you need someone to do cost of goods sold, inventory, other things, go out in town, find yourself a tax professional, pay them, and they'll prepare returns for you. Okay, vehicle expense. You see a lot of this in VITA. And this is the good thing about the VITA program. We only work with the standard mileage rate. We don't do the actual expense method. So when you talk about the standard mileage rate, it's going to be all of your business miles that you drove. And your software is going to allow that 67 cents per mile for tax year 2024. Plus, you can get what are called business parking and tolls. Like, for example, I drove down to a client in Newport Beach and trying to find a place to park. It was heavily impacted. Finally found a spot, and I went to pay for it. I was there for like maybe 2 hours, and the guy said $20. I'm thinking, okay, well, that's business parking, and for me, as a sole proprietor, that I can take that deduction on my tax return. And then in Southern California and other places, you have toll roads, and so if you're in a business mode, you can take that deduction. And then, of course, if you have a car that you're using for business, and let's say in this example, it's 100% for business. If you have a loan on that business car, then you can take that interest that you're paying as an expense, a business expense. And same thing with your DMV. If you're paying the DMV and let's say your vehicle is used 100% for business, you can take that personal property tax from the DMV as a deduction. And then this is something you're going to bump into in the VITA site. You have individuals who do not have documentation, or they won't have the calculation, or they'll say, well, I don't know. Now, what I do, and I think Mel will probably agree with me on this one, if the client's sitting there, VITA client's sitting there, try to develop the fact pattern, ask them some questions, some open-ended questions, probing questions, because generally what happens, people are going to bring some records for or with them, and then generally you're going to be able to determine approximately how many miles they drove. Sometimes taxpayers will have it in their day timer, and they'll say, this is exactly what I drove in tax year 2024. And sometimes they're going to say, well, gee whiz, I'm not quite sure. And then what we can do, we can help them develop that amount. When you're talking about the actual expense method out of scope, we don't do that. And we're not trained to do that because the actual expense method includes what is called depreciation cost recovery. We don't do that in VITA. Okay, and this is something in your software, you're going to see other expenses. And essentially, other expenses, it just depends. They have to be business related, ordinary, and necessary. And so you'll have an itemized list. And so you'll list a particular item. and the dollar amount. And it just boils down to, is this related to the business? And then a lot of people have a office in the home, very, very common, and it's out of scope. And if someone says, I got an office in the home, we don't do that. We don't do that. And that's something, if you want that particular deduction, you've got to go out in town. Now, it's not an impossible thing to figure out, but again, it's out of scope. We don't do that. Okay, and then this is something you're going to see at the VITA site from time to time. You've got a married couple, and they may be involved in some type of business that is not incorporated, and it's not a partnership. It's a qualified joint venture, kind of a mom and pop type thing. And in that particular case, that's something that you can help them out with. What will happen in the software, you'll indicate a qualified joint venture. The software then will create two Schedule Cs, splitting the income, splitting the expenses, and then you'll see that in the software. Another thing that's done automatically is self-employment tax. SECA is an acronym for the Self-Employment Contributions Act that came out in the 50s. And so when someone's self-employed and they have net income of $400 or more, the software is going to calculate self-employment tax. And that is in addition to individual income tax. And sometimes, usually it's young adults, they've never heard of that. And when they see that on a tax return, they go, what's this? You tell them, well, this is basically Social Security for self-employed individuals. And this is the general rule. Everybody pays it. And so again, that's going to be calculated on that Schedule SE. And then different lines of work. Sometimes you're going to have individuals that have different types of work. Maybe they're a flower shop and then they have a machine shop, two completely different things. Well, if you have that, then of course you have to determine if it's in scope. And if it's in scope, you're going to separate income and expenses. Typically in the VITA program, usually it's that one Schedule C that you're going to be preparing. And then you also have individuals who have hobby income or hobby losses. And so when you're talking about a hobby, you're engaged in an activity, it's not for profit. And if you have income related to that hobby, and sometimes you will, you got to report that income. You can take what are called cost of goods sold, but you can't take expenses. But typically, hobby income, you're gonna report that. You don't see it a lot, but sometimes you'll see hobby income. Okay, this is real quick. If you have a pencil or a pen or a Crayola, we'll talk about this, and this is pretty basic. And so we've got a taxpayer. It happens to be a tax practice. You can call it dog walking or whatever, but this is a self-employed individual, and this is what we have for tax year 2024. They have gross receipts of $40,000. And simply because you're a cash basis or a cash method taxpayer, you can still have accounts receivable. So for example, I'm a cash basis guy, and I report the income that I receive. And then some of my clients don't pay me when I bill them right away. So I have accounts receivable. You can have that as a cash basis taxpayer. And then sometimes you have individuals who give away their services. So I give away my services, not to everybody, to certain individuals, typically very low income. And so I call that pro bono work, and I can assign a value to it. But of course, you're not going to take any type of deduction for it. You're not going to include it in income, but you may see that from time to time. So you want to focus in on gross receipts and someone who's cash method. So let's look at some expenses. Again, this happens to be a tax practice. And so we got, and we'll just run through this. Think of ordinary and necessary. So in a tax practice, what do you need to do? Well, you're going to need some software. That's ordinary and necessary. You're going to need some supplies, paper, cartridges, pens, things like that. Your continuing education that we talked about, you're going to see this in different lines of work where there's some type of requirement to have continuing education, and you're going to pay for it. And then in the vast majority of businesses, there's some type of professional publications, online, hard copy, whatever the case is. A lot of people have mailboxes, business mailboxes. clearly ordinary and necessary. And then here are the things you're going to see from time to time. But again, it just depends on the line of work they're in. A lot of people go to the gym. I guess that's a great thing. And this is the general rule. When you go to the gym, that's a personal and family living expense. You're not going to be able to deduct that. And then a lot of people like coffee and tea, and they have their morning ritual where they get something at Starbucks or somewhere else. Well, that's what is called a personal and family living expense, not deductible. And then we talked about the cell phone. If you have a cell phone and you're paying a flat amount, you're not going to be able to take that cell phone on your tax return. Now, if you have a dedicated cell phone for your business, that's a different story. And the exception to that is if you're able to go online and determine the business calls and then essentially have an allocation. And this is where you need your pen and paper, your business miles. In this particular case, this self-employed individual drives 3,000 miles for business in tax year 2024. And so you'd have to take that 3,000 and multiply it by 67 cents per mile. And then you're going to get an amount that you can include as an expense. And then business tolls, and that would be you're driving around Southern California, and you're charged a certain amount on certain roads, and that's related to business. So this is the fact pattern, if you will, for our self-employed individual. And the question is, how much is net income, which is defined as taking gross receipts and deducting all of your ordinary and necessary expenses. And I'm going to give you a minute. And Damien, if you want someone to give a shout out and say this is the answer.
Yeah, feel free to unmute and give your answer. I've written mine down, but I'm not going to give it. So feel free to shout out any ideas, or maybe just write it down, and then afterward you can say you have it. Robert?
And then Damien, if someone has a question, please go ahead and ask them to come off mute, and we'll attempt to answer their question.
Sounds
I'm
good.
gonna go with $33,340.
Did you say $33,340?
That is correct.
Robert, is that you? That sounds like that's a pretty good answer. How did you come to that?
Well, I took the software prep, 2,000, the supplies, 1,500, continuing education, 500, professional publications, 300, the mailbox, 200, the business miles of $2,010, and did I mess it up? And then the business
Tolls?
and the tolls, 150. Add those all together. I came up with that number. What did I say?
You said $33,340 for net income.
Right. Is that correct? I think I might have messed up the
And
Let's-
it's as simple as that. And
Nice.
so when you have someone who's self-employed, typically in the VITA program, it's how much did you receive in gross receipts? What were your ordinary and necessary expenses? And then you're able to calculate that. And of course, the good thing is with the software, you're just plugging in the expenses, you've entered the information pertaining to gross receipts, and the software is going to calculate net income automatically. And I think, Damien, looks like
Yep.
you get a question from Monica.
Yeah, it looks like that, Monica.
Yes, I have a question. I'm a 1099 individual contract, but if this year I don't have a business, didn't make money, can I deduct a license fee?
Okay, so now what I understood there is you were issued a 1099 NEC. And as I've mentioned, that will evidence either all of your gross receipts or it could evidence some of your gross receipts. So again, it begs the question, what were your gross receipts in tax year 2024? And
I don't
so
have
that's
income. I don't have income.
you don't have any income?
Right.
Okay. And then do you have expenses in your self-employment?
Yeah, at least the license fee and some,
Okay. Yeah. And so when you're talking about the VITA program, Typically, we're not going to prepare returns that have what is called a net loss in the Schedule C. When you're talking about taxes, if you have a business and your doors are open and you have no income, and that does happen from time to time, but you have ordinary necessary expenses, then you will have a loss, and many times those losses are allowed. And again, you're going to hear the term facts and circumstances. And so when you're talking to a taxpayer, you're going to develop that particular scenario to determine if it's within scope in the VITA program, or when they go out in town and hire a tax professional, if they could take a net loss on their return.
All right, thank you.
Oh, sure. All right, Damien, anyone else?
I do not see any other questions.
Okay, all right. Okay, we're going to march on here. Now we're still talking a little about the sole proprietor, so just real quick here, you're going to see terms called material participation, and this is all you got to remember for the purposes of VITA. Did the individual run the business? Were they involved in an ongoing, not necessarily each and every day, but an ongoing business? And if they did the work, then you materially participate. You're going to click that in the software. I believe it might actually become pre-selected, so you just leave that alone. And then again, you want to remember when you're talking about deductions, ordinary, necessary, business purpose, and reasonable in cost. So let's say, I think I used this example before, let's say you have a business and you hire your teenage daughter to go ahead and put a flyer together for your business. You're going to post the flyer and advertise your business. Your daughter completes it. It's 30 minutes of work, and you give your daughter $9,000 for the work. Well, that is clearly an unreasonable compensation for a 15 or 16-year-old kid to spend 30 minutes and prepare a flyer for you. And so that's something that would not be allowed to the tune of $9,000. Now you'd say, okay, well, what is reasonable? Well, it's probably between maybe a couple $100 and maybe $300 or $400 for a flyer, but not 9,000. And so again, that's the concept of reasonable cost for something. We already talked about the phone. And so again, just a reminder, if you have someone who has an employee and they're self-employed, we will not help them with their Schedule C. We're not trying to do that. All right, this is something you'll see. I see this more and more for sole proprietors, individuals who are working, and they hear this term quarterly payments. And so what that means is we have a system where we pay as we go. And when you meet someone who makes money as a self-employed individual and they do not make estimated tax payments, those quarterly payments, at the end of the year, they usually get clobbered with a lot of federal tax and a lot of state tax. And so we try to educate taxpayers and we say, if you need to make estimated tax payments, that means you estimate your income. And then, of course, you're going to make quarterly payments to the federal government and then quarterly payments to the state government. And so you'll see that they'll come in with a laundry list of, yes, I made these estimated tax payments. And the rule is you want to meet 90% of your obligation during the year. So that's why you make estimated tax payments. If you're a wage earner, you're typically not worried about that because you have withholding at work. If you're self-employed, you're it. And that's why you have to make estimated tax payments. And then when you're preparing a Schedule C, if you have net profit, let's say, I'll make a real easy example. Let's say you've got net profit of $20,000. Then what will happen in your software, and this is the general rule, you're going to allow, or the taxpayer will be allowed a qualified business income deduction, which will appear on page 1 of the 1040, and that's 20% of their net income. So if someone had net income of $20,000, that qualified business income deduction would be $4,000, which is a significant deduction. It's a good thing for the taxpayer. And so that's something you're going to see on most self-employed returns or Schedule Cs. Okay, I'm going to talk a little bit about this. This can be a very involved topic, and this is my recommendation. You're going to do what you're going to do, and the site coordinator is going to do what they're going to do. But at my site, if someone says, hey, I sold my house, I'm usually going to have someone who is experienced with preparing a return for sale of a personal residence, because there's a lot of questions you got to ask. So I'm going to give you some particulars here, or maybe just, kind of pointers, if you will. So this is your go-to document when you sell your home. And when you sell your home, it can be a very basic computation, or it can get really involved. And if it gets really involved, that's when you probably want to go to that senior individual to do it right, if you will. When you sell your home, what happens is you may have a gain. And of course, if you talk to someone who's been around long enough, home prices do not go up all the time. If you talk to youngsters, they may say, oh, home prices go up 10% every year. Well, it depends on where you're at, and it depends on who you are, and depends on when you buy and when you sell. Okay, so when you're talking about a personal residence is a capital asset. And there's different types of capital assets. Shares in a corporation are capital assets. Your personal residence is a capital asset. And when you sell a capital asset, the tax terminology is called disposition. So when you relinquish title to a capital asset, you're going to calculate either a gain or a loss. And so there's certain information that you have to have. This 8949 will appear when you turn your tax return into a PDF, and there'll be a Schedule D as in Delta, and then the 8949. And then what will happen, there will be a differentiation or a segregation between short and long-term gains and losses. And when you're talking about long-term gains, they're taxed at preferential rates. And so that's why the software is going to differentiate between short and long-term. A lot of busy information, but sale on a home, you're typically going to get a Form 1099-S. It'll show the proceeds. And this is a really important topic, I should say a really important pointer. Your taxpayer is going to bring in their settlement statement. When you buy a house, typically you're going to go through escrow and you'll get a settlement statement. And then when you sell a house, you'll typically go through escrow and you'll get a settlement statement. And that will typically be that document or documents you're going to need to determine the purchase price and then the sales price of the home. And then you have to meet other qualifications, obviously, to take this exclusion that we're going to talk about shortly. Okay, so this is your formula, if you will. Your selling price, those would be your proceeds. You have selling expenses, that includes your real estate commission. You pay your agent. And then when you take your selling price and subtract your selling expenses, you come up with the amount realized. And that's not the end of the equation. And then you're going to subtract your cost, or what is called basis. And we'll give you an example in just a moment here. And then that will give you your gain or loss. And then if you're eligible for that exclusion, and that exclusion for single folks is 250,000, up to 250, and for married folks up to 500,000, and then you end up with the amount recognized. And so let's say you've got a married couple and they're excluding $500,000 of the gain. That means that's a good thing for them. And that's the amount that's going to be recognized on the return. And so this is the basic formula. This is what your software does. All right, and then again, a 1099-S, that's going to be the information return that someone receives when they sell their personal residence. And typically, people will go through an escrow, typically. And then that settlement statement is, again, your go-to document for the purchase price, the purchase date, sales price, and sales date. So typically, you're looking for both the purchase and the sale settlement statement. And then real estate commission, these are things that are listed on the settlement statement. And so you want to make sure you get that. When I talk to my clients, either a VITA client or a paying client, I always ask them, where's your settlement statement? Do you have the one that you bought the property from, or with, I should say, and then the settlement statement when you sold the property. So this is an example of a settlement statement. HUD is the Housing and Urban Development, and settlement statements, they're formatted basically the same, but of course you might have different titles. But basically it has information pertaining to when you bought the house and the various items that go into what is called cost or basis, or accountants use the term adjusted basis. And then increases the basis. Think about this. Let's say you buy your house and your house costs you, well, let's say $600,000. And then you're owning your house and you're having a great time in your house, and you decide you're tired of your backyard and you want an Olympic-sized swimming pool in your backyard. Your house costs you 600,000. That Olympic-sized pool costs you 100,000. You put it in, and now your adjusted basis of your house is 700,000, 600 plus 100. And so that's an example of an increase to basis. This is a really busy slide, and so when you talk about decreases, probably the information I can share with you, jump into the sale of your personal residence and has data regarding decreases to your basis. Okay, so we already shared this particular formula with you. This is in the software. And I always like to use the term, when you hear the term amount realized, that is not the amount that's going to be subject to taxation. The amount recognized, that's the amount that's subject to taxation. The exclusion, I think for our purposes today and maybe for the rest of the training that we're going to have here, you want to focus in on what is called the exclusion. But like you say, you got to qualify. So if you qualify for the exclusion, if you're single, head of household, you can exclude up to 250,000, which is a good thing for the taxpayer. Married filing joint, you can exclude up to 500,000. The partial exclusion, we don't do that in VITA. It's out of scope. If someone says, hey, I'm entitled to the partial exclusion, you can say, that's great. We can't help you. We're not trying to do that. You got to find a practitioner out in town. This is really busy, and so I just want to focus in on when you're talking about the exclusion. Again, you got to qualify, and that means you got to own your home, as it says on item number 2 or step 2. You got to own your home, and obviously you've got to live in your home for 2 of the last 5 years. Though 2 years do not have to be sequential. So you could live in your home and maybe move out, move back in, but you got to have 2 years in your home. And it's really important when you're talking to VITA clients, develop the fact pattern. Ask them questions, make notes in your intake sheet, and then once you make a determination they're qualified, then they can take that exclusion. We're going to pass on this. Again, this is very busy. 2 out of 5, that's probably the best thing you want to know right now. We don't do partial exclusion, non-negotiable, we just don't do it. And you can see there's examples of where you can get that partial exclusion. I like to use the example, let's say you have someone who buys a house, and let's say the wife comes home, announces to the husband, yes, I'm expecting, but it's not one baby. I'm going to have quadruplets. And the husband says, oops, we got to move. Our house is too small. That could be an example of a partial exclusion, but again, out of scope. And we're just going to run through this out of scope. So this is what you're typically going to get, the Form 1099-S, and that is your information return. And as it says on the bottom of the screen, even if you have no taxable gain, you're still going to report your sale on your 8949 and your Schedule D as in Delta. And if you have a loss in the sale of your home, and a lot of people say, well, how can that be? Well, it does happen. You can sell your personal residence and have a loss. It depends, facts and circumstances. If you have a loss in the sale of your personal residence, that's a non-deductible loss on your federal return. When you sell certain things, let's say you sell stock in a corporation that you own, that loss can be allowed on a return. There's certain limitations, but the loss in the sale of your residence, you cannot take that on a return. And if you're thinking, Jerry, that's unfair, my response to you would be, well, that's what Congress came up with, and it passes muster in the federal courts, and so that's a system that we have. Here's an example. We have someone who sold a home, married filing joint, and the home sale, the proceeds were $500,000. Their commission they pay the agent was $60,000. The amount realized is $840,000. And then, of course, we're going to account for the cost, or what we call the adjusted basis of the property, in this case, $250,000. Their gain is $590,000. And then again, if they're eligible for that exclusion is up to $500,000. And then the amount recognized shown on the return, subject to taxation, that's at $90,000. And of course, if it's held, and in this case, it was held for over a year, that means this is a capital asset that was sold or disposed of, and this is a long-term capital gain, that $90,000. State of California does not have a long-term capital gain. They just have gains. And so that's going to be a different computation on your California return. And again, this is built into your software. You just got to make sure you develop the fact pattern and enter the correct data in the software. Okay, and I mentioned this, and after this, Damien, I think we'll take a quick break. So this is your real estate withholding statement. When you sell property in California, and this is the general rule, there are exceptions. What will happen is you'll typically go through escrow, and you will have withholding, and that withholding is per state law, and then the escrow company will remit those amounts to the state of California. And then when you file a California return, you're going to account for on that California return the amount that was withheld from the sale of your property. And then you may owe some additional California tax, or you may end up getting a refund. But typically there's withholding, if I remember correctly, I think it's 3.333% for the proceeds. And again, this is a document, I've asked for VITA clients to provide this document to me. In my practice, when someone sells their personal residence, among other things, I ask them, do you have the Form 593? All right, Damien, let's take a 10-minute break and then we'll come back and run through the rest of the slide deck.
All right, thank you. We do have a question. If a taxpayer did not receive 1099s, but they did sell their home, do we need to address this on their return?
You would address it, and most likely, I mean, anything's possible. But if someone does sell their personal residence, most likely they're going to be issued a 1099-S. That's something you're probably going to see.
Excellent. And that's the last question.
Okay. All right. So we're going to run through a couple things here, and then we're going to jump into the software. So when you're talking about the Schedule D as in Delta, that's where the disposition or sale of your capital assets will appear. And so again, typically you're at the VITA site, you're going to see someone selling stock that they own in a corporation or maybe their personal residence. We don't do the sale of cryptocurrency in the VITA program. If you buy cryptocurrency or digital assets, and you can certainly be a VITA customer if you meet all the other qualifications, but if you sell cryptocurrency, that's outside the scope for VITA. And then in capital assets, there's many different types, but typically you're looking at stocks and personal residence. The 1099-B is in Bravo. That'll be your go-to document. And sometimes you're going to have a multi-page document. I had a client one time who had a 300-page 1099-B, and there's different ways to handle the very long ones. Typically aggregation, where you're listing all your short-term gains and losses and your long-term gains and losses. But your 1099-B is what you need from your VITA client. And then, of course, there are limitations to losses. Those would be computed automatically in your software. But here's what you need to get. You need to get that previous tax year. So if you're working on the 2024 tax year, you want to secure a copy of the federal and the state returns for tax year 2023. It'll have information to include if there's any capital losses that you had in 2023 that carry forward to 2024. And then in this training in December, we'll show you how to get into the software and make those entries for those capital loss carryovers. Selling a house, we already talked about this. When you hear the term capital improvements and repairs, swimming pool is that improvement. If someone breaks your window in your house, you're not happy, but you have a repair person come out. Repairs are not a deductible expense on your personal residence. And then we already talked about the settlement statements, something you definitely want to get when someone sells their real property, i.e. their house. Okay, adjustments to income. We'll run through a couple of these, not all of them. So the ones you're probably going to spend some time with would be the educator expense. So you've got a school teacher who pulls money out of his or her pocket for the kids, and that's pretty typical. And then they're allowed up to $300 per eligible school teacher. And then you're going to see student loan interest deduction. And a lot of people have student loans. I've seen people in their 70s, 70, who had student loans. And you're going to see all sorts of stuff. But again, the maximum student loan deduction is $2,500. If they paid more than that, then of course they're limited to $2,500. We're not going to spend a lot of time on this, but sometimes when you sell an item, and for example, let's say you sell your personal refrigerator, chances are you're going to have what is called it's a capital asset. You're going to have a loss on that, and then those losses on those personal items are not deductible. I think that's as far as I want to go with this screen. Let's jump into the practice return, and let me show you the fact pattern before we go to that. Just show you real quick. So this is our taxpayers, married filing joint. And if you're making any notes for now, you can go ahead and remove that item that says David made $3,500 in contributions to his 401k in 2024. That will not be part of the fact pattern today, so you can remove that. But all this other information, we're going to show you how it appears in the software. So we've got the husband who's a wage earner, and we've got the wife, she's a self-employed individual. And then here's their Schedule A as an alpha, and you can see there's a lot of items here on the Schedule A that are not deductible. And for example, whiten your teeth, that's not deductible. When you buy vitamins at the vitamin store, that's not deductible. If you've got a pet and your pet is hurt and you take them to the vet, that's not deductible. So there's certain things that are or are not deductible. And then we have the Schedule D information. And again, your 1099-B is going to be your go-to document. And typically, but not all the time, it's going to be self-explanatory. And if it's not self-explanatory, then of course, talk to your site coordinator. Sometimes a call to the broker. But I actually ask the taxpayers to do that at the VITA site. And of course, for my clients, I'll do it on their behalf. But in this case, we've got some purchase and sale of Peloton stock and then ship shape stock. We'll talk about that. All right, and then let's get to the software real quick. And so give me just a second. And if you're taking notes, this is probably a good time to take notes. And so we're going to come here. And so this is the IRS website. We showed you this last week, and this is the Link and Learn. This is where you certify, and this is where you will find a treasure trove of training information. And so let me just show you this real quick, where it says click here to see the contents of each course. We click there, and we see our laundry list of topics. And if you are going to prepare for the basic examination, you want to visit the various topics that are listed here. And of course, you've got your publication 4012, which will be your go-to document. If you take the advanced course, and this is something I recommend, I mean, everybody's going to do what they're going to do. But if you're at a VITA site, I highly recommend that you certify on the basic menu. And then once you complete that, go to the advanced menu and certify on that, because you're going to expand your knowledge of taxation. You're going to be a benefit to the site because now you can say, I'm advanced certified, and you can help out a lot of taxpayers. But these are 2 certifications. And keep in mind, before you do the basic, you have to complete the volunteer standards of conduct and the intake and interview. Cursor down here. Typically at the VITA site, you're not going to do your military menu, i.e. certification. Now at my site, I teach at Coastline College. All of my students have to be certified at the military level. And then there's other certifications. You typically won't go through those. So this is what you would do if you want to start certifying. You'd read that information we talked about, and you'd start with the volunteer standards of conduct. And we click there. And yesterday it was not working. And let's see what the current status is to certify. And it probably will give us an error message. There we go. Okay, so again, don't get frustrated. You're going to learn a lot by reading the 4012. You come to our sessions here. I think you'll learn a little bit. And then when the site opens up, you can certify starting with the volunteer standards of conduct. Okay, we're going to go ahead and make that a little smaller. And here's another way to get to the certification paths. You click there. And let me just show you again. You're going to certify as start with the basic. And you are a student. And you start with the basic course. Again, volunteer standards of conduct is the first certification level. And if you go all the way down to the bottom of the page here, you'll see where it says standards of conduct. That's the first certification. And you click there and you're probably going to get the same message that it's not up and running. And that's okay, because it should be up. And I don't, Annette, I don't know if you're still on the call, but I think typically the certifications come up about the middle of November. So that's my understanding. Okay, so again, it's not working. So let's go back to Link and Learn. I can find the right one here. All right, give me a moment here, Damien, see if I can figure this out. Okay. Okay, and this is how you get to Link and Learn. Of course, you go to the website, and let's do that. We're back here. Go to the home page. Okay, so we know the certifications don't work. No worries. We're going to still expand our tax knowledge. And now we're going to go to the Tax Software Practice Lab. And the 2024 I mentioned is up and running. Your password is Train Pro Web, and that's all uppercase, all one word. I'll display that. You jump into the software. And now here, my username and password has auto-populated. In order to use the software, all you have to do is create an account. And when you create an account, you're providing information to that IRS contractor that shares information with the IRS. And once you're done creating an account, then you're going to sign in. I'm going to sign in. You're going to see this landing page, a lot of information, but we're going to go directly to the practice area, i.e. the practice lab. And in this particular case, if you want to start a return, you would start the 2024. Now, this is a mistake that I've only made probably 1,000 times. But when you're working in software, you want to look in the upper left-hand corner to determine if you're in the right tax year. And so you can see this is 2024. I'm in the right tax year. That's what I want to talk about. If you want to change your tax year, you go to the left hand, I stand corrected, the right-hand side, and you would indicate, in this case, you have 2 choices. You can either select the 2024 or the 2023 for the practice lab. So let's, I've already entered data, so let's jump into the return and let's go to the win return. This is the David and Ali when returned. So we're going to open that up. Let's point out a few things. And if you're newer, then you're going to hopefully navigate in the practice lab and get some experience, because that's the best way to do it. You want to spend time in the lab, or in the software, I should say. Okay, so filing status, that's an important thing. You're going to learn about this in the publication 4012. And typically the more challenging filing status is going to be head of household. And of course, like anything, you have to qualify. Typically for head of household, that's going to be an individual who is either unmarried or, for tax purposes, considered unmarried. And they've got typically minor children at home, and they're paying the bills for the house. In that case, they would be subject, or they would qualify for the head of household filing status. In this case, we've got a married couple, married filing joint, marital status at the end of the year. Okay. And then here's your administrative data. And I'm going to point out a couple things. A lot of people use nicknames, but when you're talking about the name on a return, you've got to use the name per their Social Security card. And that's why we ask for that Social Security card. And that way we're able to electronically file a return. We ask for dates of birth. So you have to get through that particular portion of the screen. And so we do ask for that. And then occupation. A lot of busy items here. Probably the ones you're going to spend a little time on is, do you want that $3 to go to the presidential election campaign? It doesn't change their refund. It doesn't reduce their refund. It doesn't increase their tax. This is an order by the taxpayer to the federal government to separate those monies for that particular campaign fund. Sometimes you're going to have individuals that are over 18 and they're a full-time student. Check there. But again, whatever does apply. We have a married filing joint return. So we've got the spouse. And some people ask me, Jerry, does it matter who goes first on a return? No, of course not. Because when you file a married filing joint return, you're both subject to what is called joint and several liability. And so it doesn't matter. It doesn't matter, however you want to do it. Okay, so we've got the wife on the return along with her date of birth. For contact information, right now we just have a phone number, and we've entered that. And hit continue, and we're going to go to the next slide. We don't have any dependents here. So this is a slide you're going to spend a lot of time on. This is your money slide. And so if you have a taxpayer that comes to the VITA site, that means they've got some type of income. And so our taxpayers have W-2 income. And we open that up. That blue in color pencil is our revision item. We enter that. This is a W-2, and the mantra is you're going to key it as you see it in the software. So in this case, we've got our client, our VITA client. He works for Riverside Enterprise. We key all the data as we see it. Employer identification number. The address is populated. In this particular case, this particular company is headquartered in Ohio. The taxpayer is living and working in the state of California. So that happens. That's common. Okay, and so we've got box number 1 is your wages, right from the W-2. Box 2 is your federal income tax withheld. 3, 4, 5, and 6 are auto-populated based on the Social Security tax rate and the Medicare tax rate. If you see something that needs to be changed, let's say the Medicare tax withheld is not 508, let's say it is 507, easy breezy, you're going to make that change. And let's see if I can get this to cooperate. Okay, let's make it 506 then for instructional. There we go. So you just make the change there. But again, if there's no changes that need to be made, then you'll leave the auto population alone. Your codes down here in box 12 and 13. 12A has a number of codes, and I'll be the first to admit, I don't know all these codes, but I know where to find the definition of these codes. You can find them in the publication 4012 or in the back of a W-2. Most of the time, you're going to be working with codes D as in Delta, which is deferred compensation, or Delta Delta, DD, which is the amount that the employer has paid as far as health insurance for the employee. So that's populated. A lot of times people will be working for a company and they're covered under a retirement plan. If that's the case, we'll check it. We key it as we see it. Down here, box 14, not everybody pays SDI. I think I mentioned this last week. I've lived in California for a very long time. I've never paid a penny into SDI. I was a federal employee, and now I work part-time for the state of California, and I'm also a self-employed tax guy, and so I've never paid into it. But a lot of people do, so you'll key it as you see it from the W-2. And then down here, typically your state wages are going to be the same as your federal wages. Again, key it as you see it. And then you're going to have a state ID number, which will be different from the federal ID number. So key it as you see it. And then state income tax withheld, and that's at $1,000. And that is withheld by the employer, remitted to the state of California. And then 18, 19, and 20, you can ignore them for the VITA in California. Does not apply. Okay. And then, of course, if you had another W-2, you'd go to the upper left-hand corner and you'd add another W-2. That's very typical. You might have someone who comes in with 1 or 2 or maybe 3 W-2s. I had a guy one time at a VITA site. I think he had, I don't know, 16 or 17 W-2s, but typically I have 1 or 2. Okay. And then we're going to go to our next portion of this, and this is the Schedule C as in Charlie, and I'll show you how easy it is for self-employment. Here's our dashboard, and this is for Ali, the self-employed individual. So we're going to hit the pencil, the blue pencil. We're going to show you how easy this is. We're going to start at the top. She does not have a doing business as, and so we're not going to enter any data here. We're going to leave all of that alone. We do have to address the business code, and so I've selected one, which is based on education. She's a tutor. If you open up the business code, this is I think the term is, it is a very, very long list of codes. So you pick one close enough. In this case, education. I'm happy with that. And then we go to the next tab where it says questions about the business. And if you're newer, this is probably where you want to take some written notes. We only deal with cash method taxpayers, so we leave that alone. We don't deal with inventory, so we leave that little radial alone. And this is pre-populated. We're not going to change this for the VITA program. Material participation, we're talking about regular and ongoing involvement in the business. And if you're a VITA person, that's what you are. If you're a VITA client, you materially participate. So we're going to leave that alone. And we're also going to leave where it says all investment is at risk alone. Okay, so we're done with that tab. Hit continue. We're going to go to the next tab. And this one right here, you want to put on your gross receipts hat. And this is all of the income the taxpayer has received from this line of work. And their cash method, which means they've got a method or a methodology to account for their income. And it's up to them. And there's various ways you can do it. I've got a client, he's a doctor. He's a pretty sharp guy. And when I asked him for his gross receipts, he handed me a piece of paper and with notes in pencil. And I'm thinking, this is fine. This accounts for it. If you have QuickBooks, that's great too. However you account for it, there's many ways to do it, but you want to report all of your gross receipts. All right, we're done with that. That's income, cost of goods sold. We don't attend to in VITA. And let's go to the general expenses. This is a laundry list of ordinary necessary expenses, and we're going to come down the list here. And let's see if we see anything that that's going to, yes, we see supplies. And so if somebody has ordinary necessary expenses, you find some type of account, if you will. And in this case, we got supplies, so we put down $500 for expenses. Going to hit continue. And then we're going to go to other expenses. And we don't do depreciation. Actually, let's do car and truck first. So car and truck, here's our dashboard. We're going to open it up. And in this case, this is for Ollie. She's a tutor. She drives around in her vehicle. Apparently, she meets her clients, maybe at their home. You're going to indicate when the vehicle is placed into service, type of vehicle, and then you have to differentiate between business miles, which is something they can take a deduction for. Commuting is going from your house to your place of work, whether you're self-employed or you're an employee. Other, you're driving to church, you're driving to the laundromat, you're driving to visit loved ones. But again, you want to differentiate between that. And then all of this information toward the bottom, typically you're going to check all of them. Yes, they've got another car. Yes, they use it for personal use. Yes, they have some type of evidence. And yes, the evidence is written, whether it's written electronically or on a piece of paper. Most people have evidence of their vehicle, DMV, gas, insurance, whatever the case is. Okay, we hit there. Come back here, make this smaller. And so we've got our vehicle expense, and now we're going to go to other expenses. And in this case, now this is something that you've got to ask a few questions. Here's a scenario. We've got our tutor. Our tutor has a car, and she only uses it for her tutoring business. That's the fact pattern. And so in this case, her DMV that she pays, her DMV fee for the vehicle, is going to be allowed on the Schedule C, as in Charlie. The husband, he's got a car, and he can take his DMV taxes on the Schedule A, as an alpha. But as a self-employed individual, and again, the fact pattern is it's 100% use, so she can take that here. All right. And we're done with our entries. Then it's as simple as that. She had some mileage, and she had her DMV, and she had some supplies. And a lot of times your basic Schedule Cs will be that easy. Okay, we're going to come over here. Here's our dashboard. And you can see right here, she's got modest amount of expenses, and her net income is a little over 23,000 and change. This will be subject to self-employment tax, which is approximately 15% of the net income. Okay, we're going to hit continue. And we're going to come over here to the left-hand side of the screen. We addressed the W-2, we've addressed the Schedule C. Let's go to capital gains. When we go to capital gains, there are two different stock sales, if you will, and we can see on the dashboard, we can see the date acquired. This will be from the 1099-B, the date sold from the 1099-B, the sales amount, i.e. proceeds, and then the purchase amount. Typically, you'll see the purchase amount on the 1099-B, and we'll kind of open this up and show you how the entries happen. So we're going to determine if the stock is owned by the husband or the wife or both. In this case, both. We've got the description of the property, and this is 200 shares of ShipShape. We have the date acquired back in 2023, March of 2023, sold in April of 2024. That's clearly over 1 year. That means that's a long-term capital disposition, if you will. So we sold the stock for $3,200. We bought it for $1,500. That means we've got a gain. We got a long-term gain, and that's what the software is going to calculate. And then again, long-term gains are you've got what is called a preferential tax rate for a long-term capital gain. Okay, so we get out of that, and of course, the other entry was our other one, which was Peloton. In this case, bought it for $5,000, sold it for $2,000, had a loss. And so the net effect is we've got a net loss of $1,300. That's that little minus sign. And then I mentioned before, if you make entries and you've garbled them so bad, you just want them to go away, then you can hit that red garbage can and you'd start anew. But if you want to make revisions, that's the blue and colored pencil. Okay, we'll talk about other things, but again, not right now. We got that capital loss carryover. We're going to talk about that in the training in December. Hit continue. I want to address another thing here. These are your itemized deductions. Schedule A is an alpha. And we're going to go to our medical. And in this case, they paid out of pocket for their doctor and their dentist, $1,200. And that appears there. Okay, so that's all we have there for our medical and dental expenses. We hit continue. And then we're going to go to mortgage interest. Now, this is probably what you're going to see at the VITA site. You're going to have the taxpayer who will show up with an information return at 1098. And that 1098 is going to have all sorts of information. So you'll key it as you see it on the 1098. And so you can see right here, yes, they borrowed money to either buy or build their home. And then you've got the name of the financial institution, and then you've got the amount paid by the taxpayer to the bank, if you will. And then there's other data. How much is the outstanding mortgage, the mortgage origination date. And then if you go all the way down to the bottom here, you're going to see the property tax. And it depends. Like, for example, I get a mortgage on my house. I do not have impounds, so I pay my property tax separately. Some people have impounds, and so what happens is the mortgage company collects money from the taxpayer, and then the mortgage company makes the real estate tax payment on behalf of the taxpayer, which is the deductible amount right here. Okay, so that's that. And then we go to our next topic, and our next topic is taxes paid. And here's where you see property tax paid, personal property tax paid. Typically, that's the Department of Motor Vehicles, DMV. So you get the DMV bill, and there's a section that says this is the amount that can and usually is allowed as a deduction on your federal tax return. So we've entered that, and that's for the husband. We've already deducted the wife's DMV on her Schedule C because the fact pattern is we had 100% business use. Okay, we're going to hit continue. And then we've got gifts to charity. And we got two items. We've got cash gifts. In this case, this individual donated to St. Kilian's Church and gave cash. Typically, a letter will be forthcoming from the charitable organization. In this case, they donated $3,500. Don't get wrapped around the axle. The software allows you one date. And so if the donations were made over the year, then pick a date in the software because that's the only game in town and enter that date. And then this individual can take that $3,500 deduction on their 2024 tax return. Okay, we're done there. Let's go to our non-cash gifts to charity. And you can see right here, this individual drove for a qualified charitable organization and they were not reimbursed. And so in this particular case, they're allowed a tax deduction based on the charitable miles. And again, it goes to how do you account for the miles? It's up to the taxpayer to say, these are the miles that I drove. And sometimes that involves a little bit of a discussion because, quite frankly, not everybody has perfect records. In fact, even the IRS doesn't have perfect records. All right, so we're done with that one. And then we're going to go down, I think we're done with gifts. And so that's it. We don't have anything else on the Schedule A, so we're going to go ahead and hit continue. And then we're going to go to our federal estimated tax payments. In this scenario, the self-employed individual made estimated tax payments, also known as quarterly payments. So we go to the estimated tax payments, we open that up. And when someone gives you a laundry list of estimated tax payments along with the date, then you come to this particular screen that says estimated payments and you plug in the amount. In this case, you made $400 4 times, and this is for federal. And then she also made a state estimated tax payment. So we're going to go to the left-hand side of the screen, which says state estimated tax payments. And we're going to open up the window for state. Of course, you'll select the state of California. In this case, she made one payment of $800. And there's the date. So she would have the amount and the date she made her estimated tax payments to the Franchise Tax Board. Okay, we open that up, or close that up, I should say. And then we go to this portion right here. Health insurance, you have to address that. And if you're newer, you probably want to take a note here. When you're talking about someone who is enrolled in Covered California, and typically those are low and moderate income taxpayers, they're going to be issued a Form 1095A as an alpha, and that will be brought to the VITA site. Non-negotiable, you need that document to prepare a tax return. Because what happens is if you are in Covered California, you will be subsidized. Your health insurance, you're paying premiums, and then you are subsidized by the taxpayers. And so that's going to be reflected on the 1095 alpha. And so you got to have this document. But in this case, they don't have Covered California. They're not in any type of exchange. And so because the employer has paid the health insurance for the couple here. So the answer is no. All right. And then this is what I call a work in progress. And again, don't panic, don't get excited. For tax year 2024, the practice lab has not populated the state returns, so you're not able to do that at this point. However, what will happen when next time we meet, the state will be populated and we'll go through the franchise tax board tax return to 540. So you can see over here on the right-hand side, the adjusted gross income is a little over 55,000. And then you will see the federal amount. That is black font, black in color font, which means the taxpayer owes $947. And of course, when you finish the return, and we'll talk about this in great detail, but when you talk about finishing the return, then you're going to come down here to e-file, and you're going to enter data to get this ready for electronic filing. And here's some of the data that you're going to enter in this particular software program. So our taxpayer is going to be given a choice. They want to pay the tax. And in this case, they got some opportunities here. They can mail in their payment if they choose to. They can do a direct debit. And in this case, they want a direct debit, which means money will be taken out of their account. Of course, you've got to indicate the account. So we've got a direct debit on the federal side of the house. And of course, there are personal identification numbers, PINs, and that's pre-populated. I'm going to leave that alone. And then this, because this software is also used by professionals, you're going to see stuff like this. So we'll bypass that. There's no fees, of course. It's VITA. Now, this is something that's really important. This has unfortunately caused a lot of issues for taxpayers. It doesn't happen, thousands of times a season, but when it happens a couple, 2 or 3 times, it's a hassle for the taxpayer. So what we want to do is we want to collect data from the taxpayer regarding the account that they want that direct debit, or if they had a refund, the direct deposit. So in this case, it's a checking account. This is the name of the financial institution. The taxpayer will provide the routing number, and that routing number is public information. And so if they don't have the routing number, you can find that by Googling, in this case, Chase Bank. We have a confirmation of the routing number, and then the bank account number, the taxpayer will provide that. And again, that would be for, in this case, direct debit. The money comes out, and then you'll indicate the date that the taxpayer wants the money to come out of their account. In this case, you're going to populate it. They owe $947. And for instructional purposes, the computer says, hey, you got to select this date or a date before it. So I've got today's date. But of course, obviously, you'll have a date during the tax season. And then we'll hit continue and see what happens. Okay, and again, this is a work in progress. This is going to be obviously looking different when you're working with the actual software. Let's go one more step and see what we've got here. Of course, when you're finishing the return, it'll look something like this. And then you're going to cursor all the way down, and you're going to set this up for either ready to e-file or waiting for a signature, however your site coordinator does it. But the bottom line is you as a tax preparer or a quality reviewer, you're not going to have the opportunity to electronically file the return. that is only given to the electronic return originator, those permissions, so you can't make that mistake. And then, of course, we talked about returns in the VITA program. They're all reviewed. So when I'm at my site, I'm a tax guy and I prepare a return and I'm thinking, hey, of course it's correct. Well, my returns that I prepare are reviewed by someone else. And that's just the way it is in the VITA program. We review it. Takes a little time, but that means we want to get accuracy, and that's the important thing. Having tax returns being automatically reviewed or 100% review, as they say. Okay, I think at this point I'm going to open it up for questions. But before we do that, let me go ahead and turn this into a return. I'm just going to show you the Form 1040 page 1 and make this a little bit bigger. Now you do have an opportunity, obviously, to convert this into a PDF, and then what happens in the VITA program, we provide a hard copy federal return to our taxpayer for their records, and then typically we electronically file the vast majority of returns. So here's your 1040. Administrative data is at the top. The filing status is in the middle. And then in this case, we've got information pertaining to the wages, the W-2 wages on line 1 alpha. And then we've got, of course, the capital loss, in this case, that $1,300. And then we've got that self-employment net income, and that's a little over 23,000. And you can see how this shakes out, if you will. Our total income, self-employment, W-2. We've got some adjustments, and that's going to be what we call the 1/2 self-employment tax deduction. Adjusted gross income is simply defined as total income less adjustments, so that's AGI. And then if you are allowed your itemized deductions, so be it. If not, you'll take what is called the standard deduction. And then, of course, that qualified business income deduction, that's 20% of your net income. And so all of that shakes out to your taxable income, in this case, $22,068. In fact, I'm going to go to page 2 for just a quick second to kind of show you, because a lot of people, when they're not initiated in taxation, they think that they only pay individual income tax. Well, it just depends on who you are. In this case, they pay individual income tax, and they also pay self-employment tax because she had net income of a little over 23,000. So you see how that works. Okay, Damien, I'm going to throw it back to you and see if anybody has any questions about what we're doing, about the VITA program, and we got a couple minutes here.
Great. It looks like Anna, you've unmuted, so if you want to ask your question, we don't have any questions in the chat.
Sorry, actually I lost, to follow up on how to log into this test and, do the example on the IRS website. Just give me a hint. I'm gonna listen to your YouTube link again and follow up. My question is, all those numbers is already on a website, or how do I get these numbers if I wanted to back and follow up all this instruction?
Now, when you say numbers, are you talking about the
example
fact pattern?
Yeah, the example that you just have it, you just practice it.
Oh, well, there's a couple ways we can do it. You can certainly look at the check figures right now. And so, for example, the check figure for this particular return, your taxable income is $22,068. And so that would be a check figure. Accountants use the term check figure because you've got different numbers in an answer. And so when you enter all that data, if your taxable income is $22,068, you're on spot.
Did you practice the David and Ali again? That's the practice one. That's example.
Now, when you say the practice one, are you talking about the David and Ali win?
Yes.
Yeah,
So
yeah,
did you put those number here? So I just
yes.
locked. Okay. And
yes.
Okay, and those numbers you got it from the PowerPoint slide?
Yes, that is the fact pattern that I developed for David and Ali win.
Okay.
Mm.
Okay. Because I have a problem to follow up, all these 3 steps through the IRS and how to log in and create an account. So I got lost over there. So, maybe I have to figure that
obviously
later.
we're running out of time right now, but what we can do next session, why don't you come on once you come off mute the next session, and then we can walk through the link and learn how to get into the software and how to register for the software.
Thank you.
Well, again, it's gonna be on YouTube link, so I'm gonna listen to YouTube and practice on my own.
Yeah, either way, yeah.
Okay.
Sounds good.
Okay.
We do have one more question, really
Hi.
quick, Monica.
I get a quick question. This is Ruby. I was able to log into the VITA practice. So the next step is I have to go to the practice area. So do I need to start the 2024 return to enter all the information? And if
Well, when
so,
you go
where
to the
should
practice area, what will
Yes.
happen, it'll take you to the software. And
Right.
then if the 2024 program is displayed, which it should be, then you can start making entries into the software. But you want to look in the upper left-hand corner for either 2024 or if you want 2023, either one.
Okay, got it. And then all the figures or all the numbers to enter in the return is provided in the practice, or it's in the slide?
Well, when you get into the software, then of course it depends on the fact pattern that you have. If you're looking at the David and Ali win, you would look at your PowerPoint, and then you would use that data to enter information to the software. And I would remind you where it says in the fact pattern for this slide, David did not make a $3,500 contribution to his 401k. So you can eliminate that item from the fact pattern.
Okay,
I had to ask
perfect.
a question.
Thank you.
Wants to know if we're working at.
I had to ask a question.
We are out of time, but I want to allow that one question, so continue.
Yeah, Jerry, may I ask a question? Did I miss something, or I just noticed that the tax liability did not change after you put in the estimated payment?
The test lab.
The
Not sure what you
estimated
mean there.
payments were there previously. He did not change the estimated payments. So that's why you didn't see the amount change. Monica, you've had your hand up for quite a bit. Do you have a very quick question because we are over time?
Yeah, very quick. I missed the part of your example. You talk about groceries deduction. What's that the case can deduct the grocery receipt?
You don't deduct gross receipts. What you do is you add gross receipts to your Schedule C. And so that means if you're a cash method taxpayer, all of the income that you receive from that line of work, you're going to report it as gross receipts.
We are over time.
All the income?
All the income, yes. All the income. So if you're involved in self-employment, you're a dog walker, you're a tutor, all of the income that you have received from that line of work is reported on the Schedule C under gross receipts.
Okay, all right, thank you.
All right, thank you, everybody.
So no training next week?
No training next week. No, our next session is the week after next week or 2 weeks from now.
Hold on, Mel, you said that it's November 16th. I have on my chart that it's in 2 weeks.
Right, the 23rd is what I have. The next schedule, the next training
Mel,
is.
are you able to answer that?
Yeah, I think it's my mistake because I have an invite also for next week. So whatever Jerry says.
Yeah, and if you have your calendar, I will give you the announcement again. Our next session is going to be Saturday, November 23rd.
That's
That's
what I
our next
understood.
session.
So thank you very much. So that's in 2 weeks.
2 weeks.
I will stop the recording now. I should probably